afternoon, everyone, and welcome to the January version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you for everyone for taking the time out of your day to join us. If you have any questions during our presentation, please write them in the chat, and I will ask them to Chris if they're timely. Otherwise, we will get back to you directly or address it in our next MSON. This month's edition is titled New Market Resolutions, where Chris will walk us through our 2024 outlook amidst economic uncertainty and strong end of year for equity markets. Plus, we will address a few questions that came in on why we are bullish on energy markets. I'll pass things over to Chris. Take it away, Chris.
Thanks, Adam, and welcome everybody. Happy New Year's, happy holidays. As Adam mentioned, we had a very prolific rally to end the 2024 year. Back-to-back really strong months for equity markets, both here in Canada as well as abroad, including the bond market. A lot of what we've seen in the last year or so has been a correlation to the bond market. We're highlighting that here on the chart on the bottom left. This is charting in black the US 10-year bond yield, and in blue the US Treasury. You can see that as bond yields are coming down, the equities have rallied, and vice versa. We kind of had a challenging summer as bond yields rose on the back of continued Fed and Bank of Canada rate hikes and tepid growth expectations. And actually, the growth expectations into the future being kind of seen as going higher with the economic clarity coming, and the fact that we would see some rate hikes coming in this year. At the moment, the market's pricing in about 6 rate hikes from now until the end of 2025. We believe one of the biggest risks to the market is that doesn't come to fruition. We would see if that kind of gets kicked down the road, a big challenge for the consumer and others that are highly levered with variable rate mortgages. There is a disconnect with that between Canada and the United States, as our mortgage system tends to tilt more towards shorter term mortgages, with 60% of mortgages coming up for renewal in the next 3 years. Higher for longer environment will stress that consumer spending. Consumer spending represents about 2/3 of GDP, so you could see the correlation and what that would have on the economy. It's also interesting that only about 1/3 of Canadians now have mortgages. A lot of our baby boomer generation have paid those off over their life. And then a lot of the younger generation have not had the privilege of getting to own their first home, A, because of affordability, and then B, now because of higher interest rates. However, we don't see this as a huge concern for home prices. There is still a ton of demand from immigration, foreign buyers, as well as a lack of household formation here in Canada. Off memory, I believe Martin, our partner, brought up that there's only about 500,000 homes built a year, and we're seeing, nearly double that from an immigration standpoint on an annual basis. The other difference is the Bank of Canada has a single mandate that is controlling inflation between 1% and 3%, whereas the Federal Reserve in the United States has a dual mandate, one of as well achieving about a 2% inflation rate, and then second of all, an unemployment rate. And so they could be moving a little bit ahead of us, which would actually be strengthening or a strong thing for the Canadian dollar. The Canadian dollar has had some strength as of late, but we'd still like to see it come in a little bit more before we added back to some more US dollar denominated positions, utilizing the US dollar as a flight to safety type of opportunity. The chart on the bottom right is showing that dividend payers, of part of the market that didn't do so well over the past year and a half, started to have a comeback since late October, early November, outpacing the S&P TSX. That bodes well for our LWC, Canadian Dividend Growth Strategy. We had come into after a challenging fall, we were probably flat on that mandate and ended up over 7% on the year with very strong rally in October and November, again, fueled by that increase or decrease in bond yields. That really did help the interest rate sensitive sectors. Areas like utilities and REITs did quite well during that time period. The TSX does seem as a better value play than the S&P 500 at this point, with the S&P and now NASDAQ and Dow Jones all in and around all-time highs. The TSX does have a little bit of room to play catch up there. And we see a rotation away from the magnificent seven stocks into cheaper valuation opportunities. We're looking at things in the mid-cap space as well as healthcare, utilities, and energy, which I'll touch on a little bit later in the presentation. Fixed income has become a very attractive asset class with bond yields, rising to these levels. It's something that we are now very encouraged by. This chart on the bottom left was put together again by Martine, one of our strategists here at Canaccord Genuity. One of the concerns we do have is the overvaluation or lack of risk to reward in the credit market. So to reiterate, credit means bonds issued by corporations, governments, or govies, as we like to call them with our finance jargon, refers to government bonds issued by either the government of the United States or Canada or other sovereign nations. This chart here is showing you kind of that mismatch between the value you get with government bonds versus corporate bonds. And one of the takeaways from our recent investment committee meeting was to start to tilt a little bit more into governments. Your bond, your fixed income allocation is meant to be a place of safety or safe haven aspect. So taking more risk there for little reward just doesn't make a ton of sense. And so it's something that we're looking at right now, and you could see a change in many of your portfolios at some point this month. But we have had quite a big move in bond yields lately, from roughly 5% on the US 10-year down towards below 4, just above 4 at this point. So we would probably wait for a little bit to add to the overall fixed income allocation. But again, from our strategist call today, we see that neutral level closer to 3.5 to low 4 area. So, at that point, we'd be adding to bonds, because not only do you collect that coupon of 4 to 4.5%, you actually benefit from a declining interest rate environment. And again, tends to be a little bit less risky longer term. And so we're actually starting to tilt towards equities. And I'll get into that a little bit on our next slide. This part here is kind of talking about the strength that we've seen in the US economy. I talked a little bit about the weakness on the Canadian side. Again, I like to always reiterate that the economy is not the stock market. And I think, the decline that we saw in 2022 was the market forecasting weakness at some point in 24, 25. And then the rebound we saw kind of was the market looking through that chasm to the other side. And so we tend to look out 12 to 18 months when making our expectations, and the correlation between the stock market and its earnings growth that is historically quite high. And the consensus is that the S&P 500 will see about a 10% expansion in earnings in 2024. It's a positive backdrop, but I would reiterate that the strong rally in November and December may have taken some of those gains out of the upside, but the US is still doing quite well on the jobs front, which is one of the most sensitive or highly watched figures, because the labor market directly impacts the consumer spending opportunities. This is a new tool that we're kind of utilizing to help define where our opinions are. I'm calling it our 2024 scorecard. And it also gives us something now to, show you here today in our outlook expectation. This is kind of our outlook, like I said, for 12 months or possibly slightly more than that. But at this point, let's say for 2024, where we think things will be going. The scorecard obviously is a moving target. I would say we probably went from the extreme overweight on bonds to now just the mild overweight in the last month or two. But those changes, again, we could kind of review over time. And our plan is to, come back to this and discuss what we got right and what we got wrong at the end of the year. You could see at this point, we're taking down our outlook on equities to slightly underweight based again on those valuations, particularly stateside. I would say that that is also reflected where you see underweight a little bit on the United States and more neutral to possibly moving towards overweight on the Canadian side. I still think it's a little bit early for emerging markets, particularly with some challenges in China around growth there. The government is stepping in, and we think that that could have a turn in 2024. It was probably one of the calls we didn't get as right in 23. We thought following a late COVID restart that economy and market would come back a bit stronger than it did, and it really did underperform in 2023. A couple other points I would like to highlight here is we do think that a more active approach or paying for active management. A lot of people don't like fees, but there are times when we believe active management will do quite well. And 2024 was tough for a lot of active managers to outperform the mega cap weighted S&P 500. We think that, again, to a point we made earlier, that you see a rotation out of that Magnificent Seven group, which would give us a lift to active management. That also has us tilted towards more value stocks versus growth. Growth stocks have just done so well that we think value does have its time in the sun again here. And I talked a bit about the fixed income side on the previous slide. We did have some questions coming in on energy. We took a bigger swing on energy. We have a couple names both in the Canadian dividend space and as well on our US growth opportunities in the US market. As you can see in this chart, Kerlow only has a market weight of 4%, roughly 4.5% in the S&P 500. And interestingly enough, the contribution of energy to the earnings of the S&P 500 is at about 11%. That gap typically closes over time. So we would, the way that closes is either earnings come down or the market cap goes up, meaning the stocks are doing well. We see it as the latter, where stocks start to do quite well here. We are seeing a bit of a deficit in Q1. One of the challenges has been a bit of lack of continuity in OPEC. There's a chance that Russia is okay with lower oil prices. They have a lot of sanctioned crude that's getting to market through China and other means. They may have very easily done some deals that locked in higher prices at earlier when oil was trading above $90. And then it also is a massive benefit to the United States as the world's largest oil producer for higher prices. So that lock of continuity between OPEC plus, Russia being a big part of that plus, has shook the oil market a little bit. We did see a bit of a bounce back, but we've moved lower here today. We're big believers in the energy transition, and we think that it's possibly even a little bit overblown. As a climate supporter myself, I think it's absolutely necessary that we focus on this pending crisis. I think is very much a potential if we don't get into it. But fortunately, there was a lot of support at COP28 with nuclear. Was challenged after the Fukushima disaster, but the technology was there to prevent the Fukushima disaster, and it was just simply ignored. It was clearly written that a tsunami could have caused the damage it caused, and that precautions needed to be taken, and they just simply weren't taken. And now there's been some fantastic advancement in small modular nuclear reactors, a space that we're actively pursuing, looking at investment opportunities in. And we think that natural gas is a crucial aspect to the whole energy ecosystem. And we have exposures there through companies like Topaz and LNG out of the United States. We also added a position in a actively managed fund called the Canoe Energy Income Fund to just further emphasize our thoughts on the recovery in that space. And even at oil in the low 70s, a lot of these companies are still making tons of free cash flow. We haven't seen the overspend. We didn't see it even when prices were higher. And we think that there's probably been a bit too much emphasis on moving quickly away from hydrocarbons, even though they're a necessary component of our energy ecosystem at this point in time as we build out these other forms of energy and solutions. And we think that nuclear and natural gas are a big part of that transition into the future. And so with that, I'll wrap things up and like to thank everyone for joining today, and feel free to ask any questions. And Adam, if there's any that came in that, you know, we should talk about here today, feel free to bring that up.
Yeah, so I haven't received any questions. Last call for any questions. I'll be monitoring the chat box.
All right. Thank you, everybody, for joining again this month. Look forward to talking to you in the near future. I have a BNN spot booked for February 2nd at 11 a.m. So feel free to tune in there. We'll get a bit of a preview as to what we'll be talking about on the next edition of Making Sense of the Market. So thanks again for your trust and support in the process. We really value all of you at Team LWC.
Thank you. Take care.